Hello, everyone. Today on the Final Bar, I'm joined by Jonathan Krinsky from Baycrest Partners, who's going to share with us his take on the current environment. This week has been two very different weeks all of a sudden. You have last Friday into Monday, all about distribution, all about risk off. You have Tuesday and Wednesday, all about reaccumulation that bounce off of the 50-day moving average. Now we have today, which I would argue is the choppy day. This is the digestion day after the big meal. What is next? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the activity in the markets through the lenses of technical analysis, behavioral finance, investor psychology, focusing on the messages of price and trend and momentum and breadth and sentiment, all the information that the market can provide back to us. I was told early on in my career to focus on price action, because that represents the aggregate supply and demand, the aggregate fear and greed, or what I would consider the fear that primarily drives investors at this stage in our markets, focusing on the signals that we can see. And it is completely reasonable, whether you're bullish or bearish, to see the bounce that we did Tuesday and Wednesday off of an approach to the 50-day moving average. The question that remains, at what point will we break the 50-day? What will that look like? What stocks are going to hold up? What stocks are going to struggle? Today, we're going to focus a little bit on some of the names reporting earnings this week, because it's a heavy week. Some of them have had very quick reactions in a very short period of time. We have wonderful guests on this show and on this channel. Excited to talk to Jonathan Krinsky here in a little bit. Coming up next week on Tuesday, the 27th, we have Mary Ellen McGonigal from MEM Investments. On Wednesday, the 28th, Cliff Droke from Cabot Wealth. And then on Thursday, the 29th, technical analyst Bruce Powers joining the show once again. Also, so you know, next Tuesday, the 27th, I'll be hosting the next episode of The Pitch. That is our monthly show where we focus on stock picking ideas, stocks and ETFs from 3 guest panelists. This next episode, I'll be moderating a conversation with Greg Schnell from GregSchnell.com, Mark Newton from ML Newton Advisors, and Jeff Hughes from JWH Investments. They will all have a chance to pitch 5 ideas to you. We will discuss them as a group. You will leave with a bunch of tickers written down to dig into a little more deeply for your own process. Should be a lot of fun. Continuing on with our market recap, as I mentioned in the introduction, I see today, if you look at the last 5 days and what's happened, you have last Friday into this Monday as distribution. You have Tuesday and Wednesday as, at the very least, short-term accumulation off of a relatively weak level. Today has certainly felt like more of a digestion today. We've now eaten the big meal, we're digesting it, and this is setting the stage for that next move. And while I can't tell you which way we're going to go, because I don't have the crystal ball that we all would like to have at some point, what I can do is focus on the trends and how they're playing out, what signals we can tease out. You know, on a day like today, it's worth noting the S&P up about 0.2%, just closing below 4370. Small caps on the same day down 1.8%. And a lot of that has to do with the types of names that were leading versus lagging today. Tech and healthcare at the top of the list today. Energy and financials at the bottom of the list, and there's a little bit more of an overweight of those sectors in the small cap index. So reasonable that small caps would come down. But if you had asked the average strategist what's on your risk on versus risk off list, many of them rightfully would talk about the relative strength of small caps. Small caps tend to do better in a bull phase. They tend to struggle in a bear phase. That's kind of the standard idea because they're more risky. They're a little higher beta, usually higher risk, but higher potential return. They're struggling, and they've been struggling for a while, but especially a day like today when the S&P's up a little, small caps down a lot larger is I would argue, a warning sign more than anything else. The NASDAQ 100 outperformed the S&P today, up 0.7%, and the VIX is around 1770. Very quickly on some other asset classes, interest rates coming off through the course of the day really came lower through lunch, but came back up looking at the $ TNX, which is the 10-year yield index from the CBOE, currently around 127. The TLT, obviously bond prices that we usually follow, up about 1%. And the dollar index remains very, very flat. It's sort of been revolving around that 24 to 25 range for quite a while. Other asset classes, very quickly, the commodity complex overall stronger, even though oil prices were up a bit. Energy stocks struggling. Again, you have a mix of things happening on any given day that could impact individual sectors and groups. But precious metals up a bit, with gold up 0.2%. Finally, we have cryptocurrencies, which are sort of flat to up. Yesterday was a big rally day for cryptocurrencies. We talked about the Bitcoin 30,000 level, how important that is, because it served as support so many times. And I think Bitcoin and the S&P, if there is a similar scenario right now, it's this. Bitcoin has been bouncing off that 30,000 level for a number of times. And while that's good that it remains support, what happens when it finally does not hold? And I would argue there are a lot of people that have bought in right around 30,000. And if that breaks, there could be a flood to the exits as people feel that pain. So far, we're up a bit from there, just above 32,000. Same with the S&P bouncing off of the 50-day moving average. And let's go there next. I think the base case we've been talking about for the S&P is one of uptrend until proven otherwise. And we broke down through, I think, a key trend line, end of last week. That's a trend line that we've been looking at for a while, from the October low of last year, the March low from earlier this year. That lines up very well with some of the lows in May and June, again in early July. That finally being broken with the follow through into Monday, I would say overall sets the stage for short-term deterioration. But the key is, can we get below the 50-day moving average? And now 6+ times so far, just year to date, we have tested the 50-day moving average and bounced right back the next day. That same exact thing happened this week, with Monday's sell-off being followed by 3 straight days of closing higher to push the price back above that 50-day. So the challenge right now is whether you're bullish or bearish, the current move makes a ton of sense. If you're bearish, you usually have that big initial move, a bounce higher before the next leg lower, and that third wave lower is usually the really negative one, where you start breaking support levels. If you're bullish, you find this as just yet another bounce off of the 50-day moving average. So, if you'd ask me to pick which of those scenarios, I would certainly be more on the negative side because of the breadth deterioration that we've seen, because of the negative patterns that I would argue are not just from this week, but have been building for months, really going back to February, March, April, where you started to see breadth indicators rolling down. 93% of the S&P above their 50-day moving average back here in April. That's down to, I think, 51% as of yesterday's close. So a lot of stocks have already broken down, and especially in the cyclical sectors. Of course, the question is there enough strength in charts like Microsoft and others that keep pushing higher to hold this market up? And so far, the rest of this week, the answer has been there's been enough of that. Let's switch gears now. We talked yesterday and the day before, went through a lot of the individual or a lot of the macro charts. I wanted to switch gears today and just go through some of the names reporting earnings. We have a lot of earnings releases recently. I just want to make sure we hit on some of the key charts. There are a group of names that are reported earlier this week that I think we got some potential indications from. ISRG was, I think, on Tuesday after the close, if I remember right. And you've seen some choppiness there, but as of today, sort of resolving to the upside. This was an interesting chart, becoming extremely overbought with an RSI above 80, pulled back a little bit as the market definitely did going into this week. From there, though, we've not gotten lower than 925, and today now bouncing back to the upside. It's interesting to see a chart like this with a strong uptrend profile, really not pulling back too deeply. And look at the relative strength, which is actually making a new 12-month relative high today, actually multi-year relative high. So overall, continuing in a position of strength. Other stocks reporting earlier this week where we did not see strength was Netflix. That was earlier this week, and the price action since the earnings announcement has been relatively flat, if flat to down. What's interesting is the chart of Netflix has really been flat for a while now. Going back to July of last year, that was really the peak, even though we've tested that a couple times and broke above it briefly in January of this year. Overall, we're the same place that we were in July of last year. And overall, you can see the relative deterioration as a key mega cap stock has been underperforming. That's why it's one of the lowest ranked stocks in our large cap universe using the Scooter rankings, the StockCharts technical rating. One that has continued to move higher is Chipotle. This was a name that reported after the close on Tuesday. You can see the gap higher following through today. And so a lot of times when you have a big reaction after earnings, I always like to see if you get follow through. Do you get any sort of continued move? It's not just a one-time reaction, but continued upside. And we're seeing that today with Chipotle outperforming again today, now extremely overbought with an RSI above 80. Finally, we have a lot of the casino names have reported. Las Vegas Sands, LVS, bounced a bit yesterday, but back down about 4.5% today. And again, I would be very hesitant on days like yesterday, because even with that bounce, we're seeing a clear pattern of lower highs and lower lows. And again, I'd much rather be interested in names that are showing signs of accumulation, not seeing things that are bouncing off of extremely depressed levels. What else should we be looking forward to? And these are companies that have reported just recently. We just have time for a couple. Then we need to take a great break. Twitter is actually reporting as we're recording this after the close today. Very interesting setup overall. And in the short term, support right around 65. Be interesting to see if we can propel above the previous highs, break out of this congestion range. If so, this is a beautiful rotation to more of the bull case. On any sort of sell-off, I'll be looking at the lows around 65, and also FCX, Freeport-McMoRan. The material sector has been struggling along with all the other cyclicals. This is something that is pulling back right to the 200-day moving average, rallying a bit going into today. Does it have the momentum to continue to push higher after reporting earnings this morning? We need to take a quick break. We'll be back with my guest, Jonathan Krinsky. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Great to be back with you live every weekday at 4 p.m. Eastern, 1 o'clock Pacific. Couple quick announcements before we get to my guest, Jonathan Krinsky. Number one, if you have questions that come up as you're analyzing charts, as you're watching shows on StockCharts TV, as you're trying to answer questions in your portfolio of your own, let us know how we can help. Shoot us an email with any questions that come up and we'll answer them, hopefully in our next mailbag segment, which will be on Friday's show. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. We're on YouTube on the StockCharts channel. Just put a comment below the video that you're watching. We'll capture all those questions. Hope to hear from you and answer your question on the air on our Friday mailbag segment. Also, as a reminder, go to StockChartsTV.com. Use your email, set up a free account. You can start watching all of our great content, shows like The Final Bar and The Pitch, special guests like Jonathan Krinsky and many others, all from your mobile devices and our website. Go to StockChartsTV.com to set up for that free network. Also on all of your app stores, just search for StockCharts TV on demand. I want to welcome on my guest, Jonathan Krinsky. Jonathan's coming to us from the Minneapolis area as the technical analyst at Baycrest Partners. Jonathan, welcome back to the show.
Thanks. Always good to see you, Dave.
You as well. So I was mentioning in the market recap, sort of this digestion day is how I would describe it. We've had, Friday into Monday, the distribution, Tuesday, Wednesday, bouncing back higher. Give us a sense of your big picture assessment. We're looking at a chart of the S&P. What are you seeing?
Yeah, so if we take it back to last week, we were actually looking for kind of that elusive 5% pullback we haven't seen since last November. We thought we might be getting it. We got about 3% on a closing basis, 3.6% on an intraday basis as of Monday's low. And then, as you said, we saw those two snapback days. And what happened on those snapback days is we saw back-to-back 80% advancing volume days on the NYSE, which means that 80% of the entire volume on the NYSE was in advancing stocks. And historically, when you get back-to-back days of 80% or more, it tends to be a pretty good buy signal. Now, it's not perfect. Nothing in markets is ever guaranteed. But if you look historically since the 2009 lows, when you've seen these signals, you're up about 75% of the time looking out 10 days later. And more recently, since in the last 5 years, it's actually been higher 11 of the last 12 times. So it's been a very strong buy signal over the last 5 years. So basically what that tells us, we still think you're going to get a 5% pullback in the S&P this year, but it's probably going to come from higher levels and it's probably going to come later in this year. So, we're getting towards the end of July. Maybe that pushes us out into August, September, and we know that historically has been sometimes a rough time for the market. So I think basically it just defers the elusive 5% pullback that I think a lot of us have been waiting for, but it probably just is constructive for the next couple of weeks.
So encouraging signs in the short term based on the stocks that are actually advancing so far this week. Now, one key group that I know a lot of investors have struggled with is energy. Obviously, there's this period where energy performing so well, leading the market higher. Now the picture's changed quite a bit. What's your take on oil and gas stocks here?
Yeah, so if you go back to mid-June, energy was, as a sector, was up something like 45 or 50% on the year. And we got cautious at that point because in the entire history of the energy sector, it's never had a full year gain of over, I think, 35%. So to have that gain in 6 months was just extraordinary. It just felt a little bit, the pendulum had swung a little too far. So what we saw, of course, was this dramatic pullback in both absolute and relative terms. It was by far the worst performing sector of the last 2 months. And what you saw is that if we're looking at the XOP ETF here, it was down about 10% in the last 10 days. And historically, when you have that sort of pullback, but you're still above a 200-day moving average, that's also a pretty good buy signal because it tells you that the primary trend is still up, but you've seen a very short-term drawdown, which oftentimes shakes out a lot of the weak hands. So we actually, we've liked energy from this week's lows. We'll see. I think from a risk reward perspective, it's a good entry point. I don't know that it's gonna, show the leadership that it saw in the early part of this year, but I think it can certainly work its way back towards those old highs.
It's two great charts, Jonathan, for sure. We only have about a minute left, but I'd love to know, given this scenario, if the S&P is constructive, if we, the elusive 5%, pullback doesn't happen for a little while, we push that down the road and we continue to appreciate from here, where would you be looking for opportunities? Is it in things like energy that have been beaten down, financials maybe that have come off a bit, or is it things like the FANG technology growth types of things, Microsoft and others breaking to new highs? What would you be looking for opportunistically to play this next leg higher?
I think at this point, on a tactical basis, we're going to look back towards the cyclical areas of the market. We think 10-year yields put in a bit of a tactical low this week. I think when they got down to 1.2% or so. And the mega cap tech and growth stocks have had a very good run. That's really the key to the S&P having a 5% pullback, right? It's not, S&P is not going to pull back 5% without those big mega cap names pulling back. With that said, you look at Apple and Amazon, they just, as you've been highlighting, just recently broke out of 1-year trading ranges. So it's kind of tough to say that they're super extended on a long-term basis. But I think as they head into earnings, that kind of move into earnings and maybe after earnings will kind of maybe mark a little bit of an interim high for those type of names, and then we can see maybe that rotation back into some of those cyclical areas that have suffered over the last couple of months.
It's a great take, Jonathan. Listen, thank you so much for joining us. Appreciate you sharing your insights. Be well, stay safe. We'll talk to you again soon.
Sounds good.
It's Jonathan Krinsky. Jonathan's the technical analyst at Baycrest Partners, coming to us from the Minneapolis area. I love his discussion of some of the different particular inputs, a bit more of a constructive view than what we've seen from some of our recent guests, which is what I really value. It's frightening when we're all in agreement on what we're seeing. It makes me start to question things. And what he had seen, again, what I think a lot of investors are questioning is this pullback to the 50-day, the bounce higher, things like energy, financials all oversold. Is there enough of a bounce there to continue to elevate things? And Jonathan had a great take, particularly on the XOP, the oil and gas space. We need to continue on with this show, and our next segment is called Getting Sentimental. A lot of the sentiment data that we review is updated Wednesday into Thursday, and so Thursday is usually a good time to check in on some of the sentiment indicators out there and just see where they're at. Let's take a look. What we're going to do, sentiment data for me is sort of third in the order of priority. It starts with price, then goes to breadth, then goes to sentiment. Price is most important because it tells you what action investors are taking, right? That shows you the aggregate supply and demand, and reflected or inspired by their emotional reaction to all the available information. Breadth tells you participation. So it tells you a little bit more about the indexes that you're following and what stocks are leading and lagging. Sentiment is a very important one. And this is where anecdotal evidence becomes very important. This is where contrary opinion can be very exciting, because our investors becoming too euphoric, too desperate, too excited, too nervous. And all of that can be reflected in survey data, positioning data, and indications of volatility. And let's start there with the VIX. We were talking with a guest earlier this week, and I forget honestly who had mentioned in particular the low VIX reading. But if you look at the range of the VIX recently, it's going from 15 up to about 2250, and earlier this week we spiked up to that point, and now again coming off a little bit. Currently just above 1750. Overall, we are so low relative to where we've been for the last year and a half. And we had sort of an elevated volatility regime, is what I would describe it, right after sort of the February, March 2020 sell-off, the spike higher in the VIX to all-time high range. You then came back and settled to this range between 20 and 40. And now we are in a new sort of range from 15 on the downside to 20, 25 on the upside. So right now we're again returning back to the lower levels of the VIX. Again, very low VIX tells you about low volatility, low uncertainty. Sort of call this the fear gauge, because in periods of market drawdown, in periods when the market goes lower, that tends to be driven a lot of times by uncertainty or anxiety. That would be reflected by a higher VIX. So the spike higher that we saw into Monday, now coming back lower, we're actually mid-range to where we've been for the last 3 months. So I would argue no real huge signal in the VIX by my interpretation, because we're sort of mid-range to where we've been recently. Where we've had quite a change here, and I have these lines here representing on the AAII survey where we were 2 weeks ago when we recorded the show and last talked about the AAII sentiment. Bullish in green, bearish in red, and at the bottom we have the spread between the two. The spread between bulls and bears is literally zero. The last time it was flat was in January of this year. Before that was October of last year. If you think about those periods, those are both sort of periods of a bit of a hiccup of sorts, is how I would describe it, before the uptrend continued. Just 3 weeks ago, this was almost to 50%. We were at 48, 49% bullish, just narrowly almost touching the euphoric range. And I remember thinking, in describing, we're not quite in the euphoric level, but we're a rounding error away from that. From there, we have a steady decrease in the bullish percent or the bullish respondents to the survey. So it's just about 31% bulls. It's almost exactly the same number of bears. So for the first time in 6 months, we have an even number of bulls and bears. So the fact that the bullish sentiment came down from 49% down to 31% in 3 weeks is a pretty significant drop. That's actually fairly unusual for the AAII survey. What that might have indicated is that we've seen the bullish extreme, which was in June. Now investors are more skeptical, even with this bounce this week, still leaning more on the cautious side than the optimistic side. I think that's an important chart to watch going forward. The name exposure index, which tells you percent exposure, and this is a survey, so money managers can say 100 or 200% long, 0% equities, 100 or 200% short, and they can update once a week. Basically, this number has come down to 71%. Last week, it was about 95, 96%. So it's certainly the lowest range that it's been for the last couple months. We got a little bit lower there in the May pullback after the April peak. We got down to around 40, 45%. Currently, we're a little more elevated than that. So what that tells you is that money managers are not all in at this point. They've stepped on tapped the brakes, taking their foot off the accelerator, tapping the brakes a little bit and sort of easing off on their long positioning, but not really as much as before positioned for a raging uptrend from here. It's more of a position of caution. Finally, we'll look at the put call ratios. This is essentially looking at positioning in put versus call options. And the first one is the total universe. So it's using equity and index options. The second one that we'll look at is looking at equities only. And there are times when we look at one or the other. We'll look at a little of both today. We can see that the put call ratio is a little more elevated. Basically, a general way to think of this in a contrary perspective would be a very low reading on the put call ratio tends to be indicate broad bullish positioning or overly euphorically bullish positioning, and tends to be a more of a sell signal. It's interesting right now that the put call ratio has been steadily increasing, showing you that options investors are not all in position for ultra bullish positioning, which is where they were at the end of June, which is where they were at the beginning of June. The beginning of June is one of the lowest readings that we had. And was the lowest reading since early December of last year. So right now, it's actually the lower end of the range than where it's been. So you don't really have that euphoric signal that we have seen characteristic of market tops. Same thing with the equity only put call ratio. Again, lower range for where we've been for the last 12 months, really. So, to summarize what I'm seeing with the VIX, with the put call ratios, I would say overall, there are times when these are at extreme lows, which indicate some sort of signal that there is a euphoria or an optimism that is indicative of market tops. We're not there right now. I would say sentiment data is more gently bullish and okay, but not anywhere near extremes. Where you are seeing some extreme movements is on the AAII survey. I would say out of everything we've talked about, one of the most interesting developments is that rotation downwards in bullish respondents and bulls and bears being even for the first time since January. That is our segment, Getting Sentimental, to update on some of the sentiment data. And for me, again, as always, that helps me put the moves into context. As always, price is what's most important. We need to wrap today's show, though, and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is gold. We haven't talked about gold too often recently, just because the equity markets have provided so much fodder for a 30-minute show to discuss. But I just wanted to update on where we were at. Most recently on the chart of the GLD, I think the bullish momentum divergence we had at the end of June was a great tell. You saw the lower lows in price undercutting the mid-June low, but you saw how the momentum sloped higher. That's indicated by the pink lines on my chart. You can see how we broke back above there, tested the moving averages, the 200 and the 50-day from below, and now we've come off a little bit. And right now, we're sort of in the middle. We're at the lower end would be that support level here, sort of the 164 to 165 range. On the upper end, we have previous resistance around 171, really to 172, which are the two moving averages. At some point, gold has to break out of this range. We break above the moving averages, we break below this support from last month. You can see the RSI is almost right dead even at 50, which essentially indicates an absence of momentum, and that's about where gold has been for the last couple of weeks. It's been sideways. So as with many other assets that are sort of in a digestion phase, we wait to see which way this breaks. If you had to make me pick which way, I would assume that breaks higher, given the bounce that we've had off of that bullish momentum divergence. But we have to do it first. We'll see if the price is able to follow through. Chart number 2 is Freeport-McMoran, and this is basically a placeholder for a lot of charts of a lot of stocks that have been reporting. We'll highlight a couple of them here, but FCX is one that reported yesterday. Is that true? No, there's this morning, actually. Sorry, Thursday morning. Reported before the open, up a little bit today, up about 0.4% in line with the S&P overall. But this is a chart at a critical juncture, and this is where I find technical analysis can be so helpful. The stock had been rallying and outperforming through May, and then coming off. It's pulled back about 38.2%, which is around $30.40 or so, which just happens to be right below the 200-day moving average. So after an incredible run, the stock has pulled back a bit, and now it's pulling back to a reasonable, normal place where you might expect support. The question is, does that support hold or not? This is the same price level, by the way, that we found a low in March. It's also the high from January. So this is a level that has been resistance and support. This is a very logical place for this stock to hold. If the market is constructive from here on out, I would expect this type of chart to bounce from these sorts of levels. If stocks like this fail and FCX goes below 30, I would argue that to be a very negative sign just for the broad market as a whole. My third chart in the 3 and 3 is eBay, just a friendly public service announcement, a PSA reminding you that everywhere at all times, there happen to be charts usually that are breaking to new highs. That is just the nature of investing and the nature of the long-term uptrend in equities. eBay is our example here. Again, if you didn't know that the market had been super volatile, you wouldn't know that from the chart of eBay with this beautiful long-term base, the break above the swing highs from the first half of the year. And now once again, making a new long-term high today with a nice bounce. That's our show for today, folks. A special thank you to Jonathan Krinsky joining us from Minneapolis, from Baycrest Partners, sharing his perspective on the overall environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.